Lots of stuff to talk about today. There's no question the Dow ended on a good note, above 35,000 on the Dow Jones, and the S&P 500 closed above 4,400. And the reason why that's significant, because one of the major Wall Street firms raised their target.
Right. One of the strategists from Goldman Sachs, very well respected, raised his year-end target from 4,300 to 4,700. And basically the reason he did it is the facts have changed. Rates are lower than he expected at the beginning of the year, and earnings have been much better than he expected at the beginning of the year.
Yeah, and earnings have been really good. We go through the earnings reports. We're about 75% through on the earnings reports, and they have been really significant.
Right, earnings growth was thought to be about 65% on a year-over-year basis in the second quarter. It's coming in closer to 90%. Revenues just under 25% higher versus a year ago. 86% of the companies have beaten estimates, and in aggregate, they've been exceeded expectations by 17%. Probably the best quarter I've seen in my career. Again, we're comparing this to a closed economy, but still, the analysts have been very slow to incorporate the positive change in corporate fundamentals as the year has gone along.
Right, and you talk about how good it's been, and remember, of course, when we're telling our listeners something that they obviously know, but last year at this time, the economy was closed, companies weren't doing the business, and so when you see 100% earnings increase, that is the reason why, is because they're back in business, even with so many backlogs in supplies that a lot of companies need. But here's the other thing that companies need, and that is people. And we were on pins and needles Friday morning before the open because the ADP report, which is a precursor of the Fed's report earlier in the week, was a lousy report. So we were watching this closely on Friday morning.
Right, came in better than expected, 943,000 jobs versus an estimate of 845. Prior months were revised higher, so that's also a good thing. The unemployment rate fell dramatically from 5.9 to 5.4%, still well short of the 3.5% rate we enjoyed prior to the pandemic. And also 250,000 people returned to the workforce. So all in all, a really good employment number.
And even though 250,000 people are back in, there is still some 7 million of these workers have apparently disappeared because there are 7 million jobs to be filled and 7 million unemployed. And so there is this disconnect. But one of the things that we're watching is that wages are up 4%, and that's something to pay attention to.
Absolutely. As we talk about the inflation situation, we're often asked by clients, what does that mean for my portfolio? The Fed chairman has kind of poo-pooed it in the sense that he calls it transitory. And by that, he's talking probably about used car sales prices being up a lot, the price of lumber up a lot, price of corn, wheat up a lot. But we're thinking more about the longer-term impact of an expanding economy in the face of constraints, and that would lead to higher wages, as you mentioned, also higher rents, and both of those are significant components of CPI. So the CPI number, which is going to be released next week, will see a lot of focus because that could tell a lot about when the Fed is going to be talking about tapering.
And so you talk about CPI and the Fed talks about transitory. In other words, it's going to be temporary, and it just doesn't make sense to me because of the things that you just said. If wages are up and rents are up, that's not transitory. Your employer is not coming back to you next year and saying you need to take a pay cut now because inflation has tapered down, or that you're going to get a break in your rent a year later. That's not the way it works. So those charges are going to be more permanent.
And the real problem with that type of thinking is if those wage increases become not just transitory but persistent, in other words, wages go up 4% this year, they go up 4% next year, or rents do the same thing, that's when you start to have an inflationary psychology that can lead to much higher interest rates, which would reduce the valuation of almost all risk assets.
And we're going to talk more about this on the other side of the break. There's no better time to know what you own, why you own it, and how much you're paying for it, and there's a way to get that done.